Welcome to the deep dive. Today, we're all about money,
Yeah.
getting smarter with our money. Specifically, by taking a deep dive into Benjamin Graham's The Intelligent Investor.
Right, and we're going deep, going
Yeah.
with the 75th anniversary edition, which includes some really insightful commentary by Jason Zweig.
I know. I know. You might be thinking, like, another investing book. Isn't that stuff pretty dry?
Right.
But trust me, Graham wasn't just some investor.
Yeah.
This guy was a market-beating legend for decades.
Decades.
He basically wrote the rule book on value investing. And get this, he even mentored Warren Buffett. So yeah, when it comes to investing, his words carry some serious weight.
They do. What's fascinating is that his core ideas are surprisingly simple,
Right.
yet incredibly powerful. He cuts through all the Wall Street jargon and complexity
Yeah.
to reveal the essence of what it truly means to be an intelligent investor.
Okay, I'm intrigued. So let's unpack this, shall we? First things first,
Okay.
how does Graham actually define an intelligent investor?
Well, he starts by drawing a very clear distinction, between investors and speculators. You see, an intelligent investor focuses on a company's underlying value, its assets, its earnings, and thinks of themselves as owning a piece of that business.
So it's less about trying to make a quick buck by flipping stocks
Right.
and more about finding companies with real long-term potential.
Yeah.
Kind of like evaluating a business you might buy outright,
Exactly.
not just a ticker symbol on a screen.
Absolutely. And that brings us to one of Graham's most brilliant and enduring concepts,
Okay.
the idea of Mr. Market.
Mr. Market. Okay, I'm listening. Tell me more about this mysterious Mr. Market.
Imagine this. Every day, this fellow, Mr. Market, shows up at your door offering to buy or sell shares of your businesses. Sometimes he's euphoric,
Oh.
offering sky-high prices. Other times, he's downright depressed, wanting to sell at a deep discount.
So Mr. Market is basically the personification of the stock market itself, with all its unpredictable swings and irrational behavior.
Exactly. And here's the key takeaway. Mr. Market is driven by emotions, rumors, short-term thinking.
Yeah.
But you, as an intelligent investor, don't have to play his game. You have the power to look past those daily fluctuations and focus on the true value of your holdings.
That's a really powerful way to think about it. It's like realizing you don't have to react to every little thing that happens in the market. You can step back, assess the situation rationally, and make decisions based on logic, not fear or greed.
Precisely. And this ability to tune out Mr. Market's noise is especially crucial in today's world of 247 news cycles and social media frenzy.
Right.
As Zweig points out in his commentary, individual investors actually have an advantage here.
Yeah.
They're not under the same pressure as professional fund managers to chase the latest trends or react to every market blip.
Makes sense. It's like being able to tune out the noise and focus on the signal, on the
Yeah.
fundamentals of the business rather
Yeah.
than the whims of the market.
Exactly. And that focus on fundamentals leads us to another cornerstone of Graham's philosophy, the margin of safety.
Okay. Margin of safety. That sounds important. Tell me more.
It's all about buying assets for significantly less than their intrinsic value, kind of like getting a great deal at an outlet store. This discount provides a cushion, protecting you from the inevitable uncertainties and unknowns of the market.
Okay.
It's not just about avoiding losses, it's about tilting the odds in your favor.
So it's like having a built-in buffer, a safety net in case things don't go exactly as planned.
Exactly. Now, think about this. Zweig uses Amazon to illustrate how crucial the margin of safety really is.
Oh, okay.
Even with Amazon's incredible success.
Yeah.
If you bought its stock at its peak price back in 1999, you would have actually lost money over the next decade.
Whoa, seriously. But Amazon is like the success story of the internet age.
It is now. But even a fantastic company can be a terrible investment if you buy it at too high a price.
Right.
That's the power and the danger of market psychology.
That's a sobering thought. So even with the best companies,
Yeah.
we need to be disciplined about paying a reasonable price. It's not just about finding winners. It's about buying those winners at a discount.
Precisely. And this leads us to another area where Graham's insights remain incredibly relevant today.
Okay.
The allure and the potential perils of so-called growth stocks.
Ah, yes, growth stocks, those exciting companies that everyone is talking about.
Right.
The ones that promise to revolutionize the world and send their stock prices to the moon.
Exactly. But Graham was deeply skeptical of chasing those stocks at any price.
Right.
He saw the danger in assuming that today's high flyers will automatically become tomorrow's blue chip giants.
Well, history is certainly littered with companies that were once hailed as the next big thing, but ended up crashing and burning. Remember the dot-com bubble?
Exactly. And Zweig adds another layer here with his observations on hindsight bias.
Okay.
He points out that after a market boom,
Yeah.
people tend to remember being much more bullish than they actually were.
Oh.
Our memories play tricks on us, making us think we were smarter than we really were.
So we need to be wary of that "I knew it all along" feeling,
Yeah,
because it can lead us to make bad investment decisions based on faulty memories.
precisely. It's easy to look back and say, of course that company was going to be a success.
Right.
But the reality is that predicting the future is incredibly difficult, even for the experts.
So what's the takeaway here? Should we just avoid growth stocks altogether?
Not necessarily.
Mm.
But Graham urges caution and emphasizes the importance of a margin of safety.
Right.
Even with the most promising companies. Don't get caught up in the hype and pay any price for growth. Always remember that valuation matters.
Yeah.
And overpaying, even for a great company, can destroy your returns.
Okay, that makes a lot of sense. So we're starting to see a pattern here. Ignore the hype, focus on value, and always look for that margin of safety. But what about timing the market? Isn't that the key to successful investing, buying low and selling high?
Well, that's the million-dollar question, isn't it? And Graham's answer might surprise you.
Okay.
He was incredibly skeptical of trying to time the market, arguing that it's incredibly difficult, if not impossible,
Right.
to consistently predict those ups and downs.
Really? But there are all those experts out there with their charts and predictions.
Yes, and Zweig actually dives into the research on this.
Okay.
He shows that those market forecasts are often no more accurate than flipping a coin.
Oh, wow.
We humans just love to find patterns, even where none exist, and that can be dangerous when it comes to investing.
So instead of trying to time the market, what should we do? Just throw in the towel and invest randomly?
Not at all. Graham's advice is to focus on what you can control.
Okay.
That means finding undervalued companies, building a diversified portfolio, and holding on to your investments for the long haul.
That sounds like a recipe for patience and discipline.
It is. And Zweig adds another crucial ingredient.
Which is?
Courage.
Courage. I thought we were talking about investing, not skydiving.
Haha, it might sound strange.
Yeah.
But think about it. True courage in investing means buying when others are fearful,
Okay.
selling when others are greedy, basically going against the herd mentality.
That's tough. Our instincts often scream, run for the hills when the market is tanking.
It does go against our natural inclinations.
Yeah.
But as Graham and Zweig point out, those moments of fear and panic are often where the best opportunities lie. It's when Mr. Market is being his most irrational that the intelligent investor can truly shine.
Okay, I'm starting to get the picture. But how do we put all of this into practice? Where do we even begin?
Well, that's where things start to get really interesting.
Okay.
Graham provides a roadmap for actually applying these principles, and it's surprisingly relevant even in today's market.
I can't wait to dive into that roadmap in part 2. All right, so we've laid the groundwork. We understand the mindset of an intelligent investor. We're ready to ignore Mr. Market's mood swings.
Yeah.
And we're on the hunt for that margin of safety.
Yeah.
But where do we go from here? How do we actually put these principles into action?
Well, Graham provides a clear roadmap for just that.
Okay.
And it starts with something he calls an investment policy statement,
Okay.
or IPS for short.
An IPS. That sounds a bit formal, maybe even intimidating. Is this something we all need, even if we're not managing millions of dollars?
Think of an IPS as your personal investing constitution.
Okay.
It's a written document that outlines your goals, your risk tolerance,
Right.
and your overall investment approach. It's like a compass that keeps you on course,
Yeah.
especially when the market gets turbulent.
Okay, I'm starting to see the value in that.
Yeah.
How do we go about creating an IPS? Where do we even begin?
Zweig does a great job of breaking this down in his commentary.
Okay.
He walks you through the key questions to ask yourself.
Yeah.
Things like, what are your financial goals? How much risk are you comfortable taking? What's your time horizon for investing?
Risk tolerance, that's a big one.
Mm.
It's not just about how much money you're willing to lose, right?
Right.
It's about how much volatility you can stomach emotionally without making rash decisions.
Exactly. And Zweig highlights how easily our perception of risk can be swayed by things like recent market performance. If the market's been going up,
Yeah.
we tend to feel more confident and willing to take risks.
Yeah.
But if it's been going down,
Right.
suddenly we become much more risk averse.
It's almost like our emotions hijack our rational thinking
Yeah.
when it comes to money. We get caught up in the fear of missing out or the fear of losing everything.
Precisely. And that's why having a written IPS is so crucial. It helps you stay grounded in your long-term goals and avoid making impulsive decisions based on short-term market movements.
So it's like having a pre-commitment strategy in place.
Yeah.
A set of rules that you agree to follow no matter what happens in the market.
Exactly. And Zweig even suggests a clever way to reinforce this commitment.
Oh, okay.
He says half-jokingly that you could keep your IPS in one of those red emergency boxes labeled, "In case of fire, break glass."
Haha, I love that. A reminder that your IPS is there to guide you through those inevitable market storms, those moments when your emotions are running high and you're tempted to abandon ship.
It's a powerful analogy.
Mm.
Now, once you have your IPS in place,
Okay.
the next step is to start thinking about specific investments. And here, Graham offers a wealth of guidance, covering everything from stocks and bonds to those more exotic instruments like preferred stocks and warrants.
Okay. That's a lot to cover. Where do we even begin?
Well, Graham recognized that not everyone has the time or expertise
Right.
to become a Wall Street analyst.
Yeah.
So for the defensive investor,
Yeah.
someone who prioritizes safety and stability, he actually recommends a surprisingly simple approach.
I'm intrigued. What's this simple approach?
Index funds. Yes, even back in Graham's day, he recognized the power of diversification and the difficulty of consistently beating the market through individual stock picking.
Wow, index funds. I never would have guessed that Graham, the master stock picker, would be a proponent of something so passive.
It might seem counterintuitive,
Yeah.
but he understood that for many investors, simplicity and consistency trump complexity and the allure of outperformance.
And Zweig, in his commentary, really drives this point home. He argues that thanks to the rise of index funds and ETFs, today's investors have access to diversified, low-cost investment options that were simply unavailable in Graham's time.
It's a true democratization of investing. It allows anyone,
Right.
regardless of their wealth or expertise, to participate in the growth of the market.
That's pretty amazing. Okay, so we've got our index funds for our core portfolio,
Yeah,
the foundation of our investment strategy.
right.
But what about those of us who are feeling a bit more adventurous? The ones who want to try our hand at picking individual stocks?
For the enterprising investor, as Graham called them, he does provide some guidance.
Okay.
But he emphasizes that this path is not for the faint of heart.
Okay.
It requires significant commitment, research,
Yeah.
and frankly, a high tolerance for risk.
So no jumping in headfirst, no buying the latest hot stock tip from your brother-in-law?
Definitely not. Graham actually recommends spending a full year
Wow.
studying and practicing stock picking before investing any real money.
A full year. That's serious dedication.
It is. And he suggests using a pretend portfolio
Okay.
to test your ideas and track your performance without risking actual capital.
Ooh, that's a smart strategy.
Yeah.
It's like a dress rehearsal for the real deal, allowing you to hone your skills and see how your decisions would have played out in the market.
Exactly. It also helps you identify any biases or emotional patterns that might sabotage your returns.
Right.
And Zweig adds another layer here.
Okay.
He encourages investors to actually memorialize their mistakes.
Memorialize, as in frame them and hang them on the wall.
Well, he uses the example of Davis Advisors,
Okay.
an investment firm that has a mistake wall where they display certificates from their losing investments.
Wow, that's a powerful way to face your investing demons. But I get the point.
Yeah.
It's a constant reminder that even the best investors make mistakes.
Yes.
And learning from those missteps is crucial for long-term success.
Absolutely. Now, when it comes to picking individual stocks, Graham offers several approaches from analyzing financial statements to identifying bargains, companies that are undervalued by the market.
And he wasn't afraid to get his hands dirty, digging deep into specific industries and companies,
Right.
looking for those hidden gems that others might overlook.
One of his classic examples, which we touched on earlier, is his analysis of the A&P grocery chain back in 1938.
Right. That was a case where widespread market fears created an incredible buying opportunity.
Yeah.
even for a well-established and seemingly boring business.
Right.
But Graham also explored more complex and speculative areas,
Yeah.
like arbitrage and those special situations he cautioned about.
Let's talk a bit more about those special situations,
Okay.
since it's one of those terms that can be a bit mystifying.
Yeah.
These are unique investment opportunities
Right.
that arise from specific corporate events,
Hmm.
things like mergers, acquisitions, or even bankruptcies.
Okay, so it's not about picking stocks based on traditional metrics like earnings or growth.
Right.
It's about finding opportunities created by these unique circumstances.
Exactly.
Yeah.
For example, arbitrage involves exploiting price discrepancies between different markets or securities,
Right.
or you might have a spin-off
Yeah.
where a company separates one of its divisions into a new, independently traded entity.
So it sounds like these special situations can be quite lucrative,
They can.
but they also come with their own set of risks and complexities.
That's right. They often require specialized knowledge and a deep understanding of the specific situation.
Okay.
And Graham, always the cautious investor,
Mm-hmm.
warns about the dangers of getting caught up in the hype surrounding new stock offerings, those IPOs that often flood the market when it's most vulnerable.
Oh man, IPOs. Remember the SPAC craze a few years ago?
I do.
So much hype, so many disappointments. It seems like a classic example of getting caught up in the allure of easy money.
Exactly.
Yeah.
And that brings us back to one of Graham's core principles.
Okay.
Always be wary of those market darlings,
Right.
those companies that seem to defy gravity but often come crashing back to earth.
So a healthy dose of skepticism is a must-have for any intelligent investor.
Absolutely. Don't get swayed by the hype.
Right.
Focus on the fundamentals.
Okay.
And always remember that margin of safety.
Okay. I'm feeling more and more like a Graham disciple with every passing minute. But even with all the right tools and strategies,
Yeah.
investing can still feel like a pretty solitary pursuit.
It can.
That's just you versus the market, right?
It can feel that way.
Yeah.
And that's why Graham actually devoted a good portion of his book to exploring the psychology of investing, the emotional challenges that every investor faces.
Oh, I'm really interested in this. We've talked about Mr. Market as this external force.
Right.
But what about our internal Mr. Market?
Yeah.
Those voices of fear and greed that can sabotage our best intentions.
Graham had a fascinating way of addressing this.
Okay.
He introduced the concept of an investment counselor,
Okay.
someone who could provide not just financial advice, but also emotional support and guidance.
Like a financial therapist, someone to talk you off the ledge when the market is tanking and you're about to sell everything in a panic.
Exactly. And Zweig, in his commentary, provides some very practical advice
Okay.
on how to find and work with a financial advisor who truly has your best interests at heart.
This is so relevant today.
It is.
With so many different types of financial professionals out there, from traditional brokers to robo-advisors, how do you choose someone you can trust?
Zweig offers some excellent questions to ask potential advisors.
Okay.
Things like, will you always act as a fiduciary?
Right.
Or do you earn more for recommending certain products or services?
So it's about making sure your advisor is legally obligated to put your interests first and isn't incentivized to sell you products that might not be right for you.
Exactly. And Zweig also emphasizes the importance of finding an advisor who doesn't just manage your investments, but helps you create a holistic financial plan.
Because investing isn't just about picking stocks and bonds, it's about achieving your life goals.
Precisely. It's about aligning your financial resources with your values, your priorities, and your long-term aspirations.
Okay, that's really powerful. So we've got our IPS in place.
Yeah.
We're learning how to pick stocks. We're even thinking about finding a financial therapist, an advisor.
Right.
But one question keeps nagging at me. Does Graham's approach really work in today's market? I mean, his book was written decades ago, and the world of investing has changed so much.
It's a valid concern. But to address this, Zweig includes a fascinating chapter
Okay.
from a speech that Warren Buffett gave in 1984,
Okay.
commemorating the 50th anniversary of Security Analysis, the classic textbook that Graham co-authored with David Dodd.
Ooh, a Warren Buffett cameo. This is getting good. What did the Oracle of Omaha have to say about Graham's legacy?
Buffett's speech was titled The Super Investors of Graham and Doddsville.
Okay.
And in it, he analyzed the performance of a group of investors who had consistently beaten the market over the long term.
Sounds like a pretty exclusive club. What was their secret?
Buffett argued that their success wasn't due to luck or some magical formula.
Okay.
Rather, they all shared a common intellectual origin. They were all disciples of Benjamin Graham.
So they were all following the principles of value investing,
Yes.
seeking a margin of safety, ignoring the market noise, focusing on the long term.
Exactly. And Buffett's analysis provided compelling evidence that Graham's approach wasn't just a relic of the past.
Right.
It was a timeless and powerful philosophy
Yeah,
that could generate superior returns, even in the modern market.
that's reassuring. It seems like Graham's wisdom has truly stood the test of time.
It has. And in his speech, Buffett offered some additional insights into Graham's teachings,
Okay.
emphasizing the importance of patience, discipline, and the ability to think independently.
He even shared some personal anecdotes about his own investment journey,
Yes.
highlighting the lessons he learned from Graham and how they shaped his own remarkable success.
It's a fascinating glimpse into the mind of one of the greatest investors of all time. And it reinforces the enduring power of Graham's principles.
All right, so we've got a solid foundation in Graham's philosophy. We've learned how to craft an IPS, we've explored different investment approaches,
Right.
and we've even seen evidence that his methods can still work in today's market.
Uh-huh.
But I have to ask, what about the emotional side of investing?
Yeah.
How do we deal with those inevitable moments of doubt and fear? Feels like we've covered so much ground already, but I know we're not done yet. The emotional side of investing is something I really want to dig into a bit more.
Yeah.
It's one thing to have a strategy,
Right.
but sticking to it when the market is going haywire, that's a whole other challenge.
You're absolutely right. Knowing what to do
Yeah.
and actually doing it,
Yeah,
especially when fear or greed kicks in, those are two very different things.
for sure.
That's why Graham spent so much time emphasizing the importance of being an intelligent investor. And that goes beyond just crunching numbers.
Right.
It's about cultivating a mindset
Okay.
that can weather those inevitable market storms.
So how do we develop that kind of unshakable mindset? Is it something we're born with, or can we actually learn it?
It's definitely something you can develop over time, and Graham offers some really insightful guidance here. Remember our friend, Mr. Market,
Oh, yeah.
the one who's always offering to buy or sell your businesses at wildly fluctuating prices.
Oh, yeah, I remember him. The manic depressive fella who can't seem to make up his mind.
Exactly. Well, Graham's key insight is that you have the power to choose
Okay.
how you respond to Mr. Market's antics.
Right.
You don't have to react to every little swing in the market.
Yeah.
In fact, you're much better off tuning out the noise and focusing on the long-term value of your holdings.
It's like having a poker face, right? You don't want to let your emotions show,
Yeah.
even when the stakes are high.
That's a great analogy.
Yeah.
And one way to cultivate that poker face, that internal calmness, is to build what Zweig calls an internal margin of safety.
Internal margin of safety. I'm intrigued. Tell me more.
Think of it as an emotional cushion, a reserve of resilience. That helps you stay grounded when the market gets turbulent. It's about developing the discipline to stick to your investment plan, even when your instincts are screaming at you to do something drastic.
So it's kind of like having a mental buffer zone, a space between your emotions and your actions that allows you to make rational decisions even when you're feeling stressed or scared.
Exactly. And one way to build that internal margin of safety is to cultivate a healthy skepticism
Okay.
towards market forecasts and predictions.
All those so-called experts who are always telling us what the market's going to do next.
Yeah.
I've noticed they're often wrong, or at least not consistently right.
That's because, as Zweig points out, no one can predict the future with any real certainty. And trying to time the market to perfectly catch those peaks and valleys is a fool's errand.
Okay, so rather than trying to outsmart the market, we should focus on what we can control.
Right.
Building a diversified portfolio, investing in companies we understand, and holding for the long term.
Precisely.
Mhm.
And remember, as Zweig keeps reminding us, investing is not a sprint. It's a marathon.
Right.
It's about pacing yourself, staying disciplined, and not getting distracted by the noise along the way.
I love that analogy. It really puts things into perspective. But what if you do find yourself getting overwhelmed, feeling those doubts creeping in? Where do you turn for support?
That's where having a trusted financial advisor can be invaluable. Think of them as your coach,
Yeah.
your guide, your accountability partner on this investing marathon.
Right. Someone who can not only provide financial advice, but also help you navigate the emotional ups and downs of the market.
Exactly. And if you're looking for an advisor, Zweig provides some great tips
Okay.
on how to find one who truly has your best interests at heart. Look for someone who acts as a fiduciary,
Okay.
someone who is transparent about their fees, and doesn't earn more by pushing certain products.
It's about finding someone you can trust, someone who understands your goals and values, and who can provide that much-needed support and guidance when the market gets rough.
Absolutely. Now, before we wrap up this deep dive, I want to circle back to something that Graham emphasized throughout his book,
Okay.
the importance of being an intelligent investor.
He said that a lot, but it's easy to just gloss over it.
It is.
What does it really mean to be an intelligent investor?
It's not just about following a set of rules for blindly applying formulas. It's about developing a mindset,
Okay.
a way of thinking about investing that prioritizes logic, reason, and a long-term perspective.
So it's more about cultivating certain habits of mind,
Yeah.
certain ways of approaching the market and making decisions.
Exactly. It's about being a student of the market, always learning, adapting, and challenging your own assumptions.
And recognizing that investing is not a get-rich-quick scheme.
Right.
It's a lifelong journey that requires patience, discipline, and a willingness to stay the course even when things get tough.
Well said. And I think that's what makes The Intelligent Investor such a timeless and powerful book.
Yeah.
It's not just a guide to investing. It's a guide to life. It's about making smart decisions, managing risk, and building a future that is both secure and fulfilling.
You know, I was a little hesitant to dive into this book, but I have to say it's been an incredibly insightful journey. It's giving me a whole new perspective on investing, and I feel much more confident and prepared to navigate the market.
That's great to hear. And remember, as Zweig so eloquently puts it,
Yeah.
to be an intelligent investor, you must be a lifelong student of yourself as well as of the market.
So a final takeaway for our listeners: embrace that journey of self-discovery, learn from your mistakes, and never stop seeking knowledge and growth, both in your investments and in your life.
Beautifully said.
Well, that's it for our deep dive into The Intelligent Investor.
Right.
I hope you found it as insightful and empowering as I did.
Good.
Until next time, keep those minds curious and those portfolios growing.